at the end of the year it was, end of or throughout 2024, Goldman, at the open of January trading, pushed out their $3,000 gold price projection all the way out to 2026. And that was based solely upon synthetic market expectations that a rising dollar and bond yields, that could be through rate cut expectations being diluted, et cetera, that this is going to cap gold from rising to 3,000 in the short term. That was their rationale. They openly said that. Now, truth be told, though, footprints affirm that Goldman Sachs are very long both physical gold and silver for their own books.
At the start of January trading in 2024, Goldman Sachs postponed its $3,000 gold price projection to 2026. Their reasoning was based on synthetic market expectations, suggesting that rising dollar and bond yields, possibly due to diluted rate cut expectations, would limit gold's short-term rise. However, market activity reveals that Goldman is heavily invested in physical gold and silver for its holdings. Andrew Maguire, a well-known precious metals trader, explains that gold lease rates have spiked to levels last seen in 2002, when physical shortages drove significant rallies in gold and silver prices. Unlike paper assets, bullion cannot be printed, so prices must rise to incentivize enough supply to restore market balance. This dynamic, combined with growing demand from central banks, sovereigns, and pension funds seeking physical gold for zero counterparty risk, widens the gap between paper and physical markets. The increasing preference for physically settled global exchanges over cash-settled systems like LBMA and COMEX highlights this divergence. Andrew highlights: traditional analysts relying on the historical dollar and bond correlations overlook the growing influence of physical markets. Rising bond yields, unsustainable debt levels, and geopolitical shifts like Trump's tariffs accelerate diversification away from Western financial systems. With liquid physical exchanges now driving price discovery, the constraints of legacy markets are breaking down, signaling a transformative shift in how gold and silver prices are determined globally. For more details, be sure to watch the full video. If you find the content valuable, don't forget to like and subscribe to stay updated with the latest insights.
Spiking up to 2002 levels, and the last time we saw them was when gold was trading at $300 back in 2002, and physical shortages drove a $600 rally in gold from here to here before any kind of settlement of those imbalances. And in silver, we saw a similar, but in this case, it was an $18 silver rally. And again, from here to here before these EFP imbalances were restored, i.e., they were able to be arbitraged successfully. Now, look, the point is, bullion cannot be printed. So prices had to rise to incentivize enough bullion to come on offer to restore the balance.
Now, what's missed by mainstream media analysts is that global central banks, sovereigns, institutionals, they're moving to swap this much higher risk first-year US Treasuries for zero counterparty risk first-year Basel III compliant gold for physical delivery. And how this is exacerbating this widening paper to physical divergence. And as we've relayed in previous episodes, it's not just central banks and sovereigns hedging dollar exposure. It's pension funds, fund managers who've got trillions under management. And if you remember, we drew attention to UBS, we drew attention to Swiss pension funds and others. Now, I've had so many questions, though, on this. So let's look at the effect of this through physical market lenses and step through what has led to this and why this will ultimately shake gold and silver free of COMEX-driven paper shackles. Now, what is not being factored into current gold and silver price forecasts is that physically settled global gold and silver exchanges outside of the cash-settled LBMA CME ring fence have now become, and this is important, sufficiently liquid enough to break free of of these historical inverse dollar and bond correlations. The lines have crossed, and there is just no going back. Rising bond yields resulting from impossible to justify rising debt levels into also a wrong-footed Fed. It's pretty obvious. And the unknown effect, obviously, of Trump's upcoming tariffs. They're accelerating these diversifications. Now, old guard, Western-facing analysts relying on historical correlations to endure see rising bond yields and a rising dollar as limiting gold's upside because their assessments are blinkered on how real physical prices are being discovered outside of the legacy cash settled markets. That, in fact, the bulk of these very large arbitrable spreads are destined actually to be cash settled, with very limited physical gold flows from London to COMEX New York vaults. And I'm talking about gold here. Now, for example, and we touched on this in our last episode. Now, while still bullish on gold at the open of January trading,
Andrew also exposes that silver as a monetary metal trades as an FX cross against the dollar, with U.S. regional silver prices showing premiums to spot. This dynamic tightens global supply, draining cheaper London benchmarks. Short-selling futures to buy spot is increasingly risky as silver's free float nears critical thresholds. Proposed 25% tariffs on silver imports from Mexico and Canada, key U.S. suppliers, have driven a spread of up to $1.30 between spot and March futures, with the current contango spread at around $0.70. These tariffs and supply constraints threaten to exacerbate market imbalances. Andrew points out that momentum-driven COMEX traders holding 75% of open interest have been short-selling March futures, betting on spread normalization. However, rising spreads could force shorts to unwind, risking spiraling prices. Former J.P. Morgan director Robert Goddell warns that unhedged U.S.-centric shorts, including Federal Reserve-linked derivative bets, face significant losses. If tariffs are imposed as London stocks dry up, a $3 premium at $30 spot could breach long-standing resistance at $32. Triggering a more significant short squeeze and amplifying market volatility. Now, let's get back to the interview.
Silver is a monetary metal trading as an FX cross against the dollar. So the risk of a US regional silver prices trading at a premium to spot will impact the global FX crosses, and it's going to continue to attract critically tight, cheaper Loco London benchmark global supply. It more draining out. So the risks of short selling futures to buy spot, you've got a higher futures price. So you would traditionally, you'd sell that and buy spot and you'd be hedged. But there's a massive risk to that because the risks of short selling futures at all to buy spot is far too dangerous when silver free float is at risk of dipping below its critical threshold, as this would further expand the spread. And as providers of the bulk of US silver supply, the proposed very large 25% duties on Mexico and Canada are particularly in focus, as this threat has largely been responsible for driving this large up to $1.30 spread between spot silver and March futures. Now, currently today, it's Wednesday, and we're looking at a 70 cent. It's still, the contango spread is still enduring at around 70 cents. Now, while there's an element of naked long speculators chasing silver higher, you have to remember that traditionally the cartel or the market makers they realize it's naked short, naked long, so they'll take the short side of that. But there is an element of that. 75% of all COMEX open interest, though, is in the hands of the momentums. And it is these heavily leveraged COMEX-centric actors that have been reported to be short-selling March futures at these over $1 premiums in anticipation of this spread normalizing. However, and if you remember in the oil trade, they tried it one day and it went below zero. If you remember that, unless you had a swimming pool where you could tip the oil into, you could not take delivery. So So we've had obviously some other institutionals coming out. We've got former JP Morgan managing director Robert Gottlieb. He assesses, and I just read his Bloomberg piece. He says, if the spreads keep rising, these traders risk, of course, incurring these heavy losses as they seek to unwind their positions. And their efforts to buy their New York futures contracts back from having short sold it to make the market risks sending prices spiraling even higher if they can't do it in an orderly fashion. Now, the likely best case for unhedged US-centric shorts, that includes the Fed-held OCC derivative bets, is that the net effect would balance out at around perhaps 10%, because there's going to be a net effect, which LBMA and Bank of America liquidity providers estimate would be very similar to the effect tariffs had netted out on when the LME benchmarked aluminum, as you call it. Now, nevertheless, so that would be a kind of like a netting out, because you've got less people buying it. You've got the arbitrage effect, but you've also, the price ramp actually will actually see less demand. Nevertheless, at spot, even at 10%, at spot $30, 10% would equate to a $3 premium. That would be $33, which would be sufficient to blow through, this is the important point, blow through long-standing COMEX-centric options resistance at $32, opening up an even larger short squeeze. So once it starts, there is very little to stop it. And an even greater risk for the COMEX shorts would be if the threatened 25% Mexico-Canada tariffs are imposed just as stocks in London dry up.
These developments underscore the shifting dynamics in gold and silver markets, where physical demand, geopolitical factors, and structural imbalances increasingly influence price discovery. As the divergence between paper and physical markets grows, the potential for significant price movements and market volatility continues to rise, highlighting the importance of staying informed about these evolving trends. How might the growing preference for physically settled exchanges impact the dominance of traditional cash-settled markets like COMEX and LBMA? What strategies can investors adopt to navigate the potential volatility caused by tariffs and physical supply constraints in the silver market? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.